Prateek Agarwal as well in the show with us. Hi Prateek, morning, good to have you on the show. It's really been a one-way move up, Prateek, since the budget and that big defining re-rating moment that it turned out to be for markets. Having said that, a bit of a pause, some consolidation could be par for course. Where are the pockets where you feel that one needs to profit take and are looking a little overvalued / overheated right now?
Yeah, so one on the market, we do believe there is upside. But yes, that said, the rally has been sharp, maybe induced a bit because of short covering kind of activity, and yes, because of continued FI inflows. Now, in terms of spaces where valuations could be troublesome, I think if a case can be made that FY22 numbers are going to be significantly ahead of, let me say Q3 annualized numbers. Otherwise, next year, the first quarter is a washout quarter in terms of base. So most companies will deliver growth. Those are companies which can sustain valuations, probably improve on the same. But others could stagnate. At least that is the thought in the mind. Now, in this pack, consumer staples, for example, where the volume growth is just about double digit, and we could see some swing on margins, could be a suspect. So, I would watch out for that. But otherwise, I would believe most part of the market should sustain valuations, even improve going forward.
The only problem with that, right now, Prateek, is that good numbers as well are not really exciting stock prices the days the market is quiet. And we've seen that time and again play out with many earnings, be it a Balkrishna Industries or as recent as Tata Steel as well yesterday. You think, more and more sectors wherein there is earnings growth and visibility expected are running up ahead of the earnings themselves?
So we have had a sharp rally. People need to get used to a particular price before the next leg starts. Now, before I develop that, let me talk in terms of the market and what kind of an upside we see there. The result season has been good. We will end in the 500s EPS for Nifty. So as of now, people believe it will be closer to 520. This is after 7 years that you are breaking the 400 barrier for Nifty EPS. And 22 could be straight 700 plus and 23 800. Take a discounting to that, multiple to that for index target, and from where we are, we see a 12-13% kind of an upside over the next 1 year. So that is the kind of number you see on the index. Now, if you divide it on a per month basis, it is a % a month kind of market move. It is not 3% a week kind of a market move. So, we will have to get used to a slower pace as we go forward. But in that context, we do believe most of the names should sustain valuations, if not improve valuations. We do believe high liquidity, low interest rate scenarios should sustain for longer. The EPS growth that we will see over the next 2 years will be sharp, and hence, while valuations on PE may correct, yet these stocks may deliver some upside.
Okay. Prateek, do you see more action shifting to the mid-tier and smaller cap companies, given that markets are already at these levels and perhaps now there will be broader participation? I mean, we've started to see a little bit, but do you see it intensifying?
Yeah, we have been talking about it for some time now. So multiple things happening for this space, and we are not traditionally mid-cap bulls, but we are positive this space just now. For one, if you look at government policy actions, a lot of it benefits the mid-cap space. So when they improve import duty protection, it is the midcaps who benefit because they are the guys who are mostly into manufacturing, for example. The PLI schemes, every participant that we have seen till date is a midcap company. Government policy action clearly is helping. Second, if you look at globally, the commodity prices being up, while Tata Steel may be a large cap company and JSW may be a large cap company, but the breadth of companies in the steel manufacture commodity space are mid caps. They are benefiting. There is another thing which is happening. If you look at the makeup of the market, what you have seen is while FIIs have been pumping in money and they're getting a lot of attention, and funds have been losing money. If you look at the counterparty, which is Indian retail, they have raised humongous amount of money over the past 3 months, close to upwards of 2 lakh crores. Now, some bit of that may have gone to real economy in terms of housing purchases, auto purchases, etc. But a lot of it is getting reinvested back on their own into the market. So the retail activity or non-institutional activity in the market is very high. That again means the breadth of the market could stay good for longer. Thirdly, the benefit of COVID, is occurring to large cap IT, but also to lot of mid cap IT. China plus one sourcing strategy that people are focused upon these days benefit a lot of chemicals, pharmaceutical companies, which most of them lie in the mid-cap space. We are looking at a lot of tech companies getting listed. Some of them got listed over the last 2 years, many more will come. And all of them, most of them would be in the mid-cap space. So this space is seeing a lot of action, and we do believe the stock price buoyancy could sustain for longer.
Okay, so that's on the mid caps as well. And talking about some of those pockets that you picked up on cyclicals and a lot of sort of interest building there within that basket, what would be your preferred pockets?
So banks, lenders are where we are really focused on. Tough to be overweight the index given the weightage in the index itself, but this is the space to look at. The NPA cycle is behind us. We believe going forward, this is a space which will lead the profit growth, and the bad part of the cycle is behind. So, and in many cases, valuations may still be favorable. Within lenders, I would say NBFCs stand out, the best of NBFCs. Whatever I am saying is the best of the lot. In lending, you have to be amongst the better ones because the bad ones die off, is our belief. So the better NBFCs have a lot of tailwinds for them. The markets have opened up. They are able to deliver better names because cost of money for them is going down sharper than their own lending rates. And they are in segments which are still growing. So yes, banks have started to focus there, but these guys are still continuing to grow. So NBFCs and NBFC-like banks are the spaces that we are really focused upon in the deep cyclicals.
Okay, got it. And in terms of the commodity space as well that you touched upon, does that spread also to other ancillary plays? Would you look at, apart from steel, would you look at cement? Would you look at some of the other materials providers? Is that a segment that's also looking interesting to you as a segue to or as a proxy to the growth story play that we're tracking?
Sure. So just a line on metals. It's a very, very difficult space. The stock prices track the commodity price only to extent. After that, everybody knows that the kind of margins a business may be making is not sustainable. Typically, these trade on price to book. Average is around 1.1. We are there. So it's not as if they can't trade higher. but whenever they have traded higher, they have tended to come back to 1.1 and then below. And a very, very volatile, difficult to predict space. So we have stayed away. Cement is something that we like. A lot of tailwinds there. The pricing discipline is definitely been demonstrated over very long periods of time. And that discipline has ensured that the better players in this space are making significant amounts of money. While the overall space does not, the weaker ones are just about with their heads above water. But the larger, more efficient ones are able to make significant amounts of monies. And that's the space that has been finding representation in our portfolios for a very long time, actually.
All right. Prateek, thanks so much for joining us this morning. Good chatting with you as always. And
thank you.
And getting a good sense of things as they stand and as your portfolio is suggested.